We'll wait for like a couple of minutes for people to join.
Yeah, I saw. It's interesting. I have my Teams is always open here on my computer, and I get a lot of notifications that people are joining a Teams meeting as well for this. Strangely.
Perfect. And I'm keeping an eye on admitting people,
Okay.
and I have to make sure that I know the people that they are in. One time, believe it or not, we got hacked.
Oh my gosh. The Zoom got hacked?
Yes,
Wow. Yeah.
and that wasn't fun. I felt sorry for the presenter. We had to send another invite, and that's the world that we're living in.
Yeah. And what did they do? Did they just bombard the conversation with interruptions?
No, sir. It was a wonderful, nasty video.
Oh, wow.
Oh is right.
Oh my goodness.
Uh,
Oh my goodness.
Popped up all of a sudden, and was so embarrassing.
I mean, at least you can laugh about it now, right?
Oh, yes, I had to, but you had to act fast. But it was 10 seconds of horror.
Oh my gosh.
I just sent another reminder. We have a WhatsApp group for people if they are interested in joining.
Okay.
Well, out of respect to everybody's time, I'd like to be on time. I think we're 5 minutes past the hour. So let's get started. And when people join in, they can join in at their convenience. Good morning, everybody. This is Osama Tawfiq. We're starting one of our lectures and presentations today. It's a little different from learning about pathology in medicine, but trust me, it is as important about learning about pathology. It is about your personal finances, about your ability to navigate the maze of the financial world that will help you, will help your family, and will help your business and career as well. We are so delighted to have Mr. Reed accepting and volunteering to give this presentation. We really appreciate his volunteering to do that, and you would hear what he's saying and you will understand how relevant and important that issue is for you, particularly for the younger people, not geezers like me, who had to learn the hard way about navigating the financial system in the US and in Canada, for colleagues that are with us. And even from Egypt and other countries like Dr. Mustafa with a Sudanese background, that we will learn a lot about how we do it here. Please make sure to mute your and be muted. So for the presentation, Jesse is going to have a short presentation to allow for questions and answers for you guys. And you could do that by either using the chat box or by allowing time for people to ask questions directly. And I like that approach, so we can learn a lot about his experience in taking care of us. This lecture is going to be, like always, posted on YouTube channel and our website for you to learn from it. Now for the introduction of Mr. Reed. He is a member of the creative planning firm that I've been personally working with. I'm very pleased. It's now a national firm, one of the best in the country. He serves as a private wealth manager, working directly with his clients to create and maintain a customized financial plan addressing all aspects of healthy financial life, including investments, tax planning, risk management, retirement, employee benefits, and estate planning. He has a unique background because he started actually as an air pilot for he was an F-A-18 fighter pilot in the U.S. Navy. After graduating from the prestigious Navy Fighter Weapons School, more affectionately, as he stated, known as the Top Gun. And you guys remember the movie. When he retired, he became a financial planner, and he has a Bachelor of Science in the degree from the United States Naval Academy. He is a certified financial planner, and we're looking forward to his help taking care of us and addressing all your financial needs. Jesse, welcome aboard, and thank you again for your presentation.
My pleasure. Thank you for the flattering introduction. So as he stated, oh, go ahead, please.
Can you share your screen?
Yeah, I'll share that right now.
Okay.
Yeah, I'll go ahead and do that. Well, let's do that
I will
first to make
mute
sure.
myself then, and platform is yours. Okay.
Okay, so share. All right. Is everybody, Sam, are you seeing the full screen there? Just one more check to make sure it's working okay?
Yes, sir.
Okay, excellent. Well, thanks again for that flattering introduction. Again, Jesse Reed here with Creative Planning. I think we consider ourselves a pretty humble firm, a little firm there. But I do like to talk just briefly about our accolades, not so much because we want to brag about it, but just to show the credibility of the kind of people that we hire here and the kind of organization we are. But just a few months ago, actually, we were ranked as the #1 comprehensive wealth management firm in the entire country by the Wall Street Journal, which is, as many of you probably know, one of the most influential financial periodicals that's out there. And so we're pretty pleased with that and pretty proud of that. And as he noted, I'm a certified financial planner. What that means to folks like you, there's a lot of designations out there, just like there's a lot of different kinds of doctors. Certified financial planner is really the gold standard of financial planning. So that is our focus at Creative Planning is holistic planning, whether it's investments, estate planning, business planning, retirement planning, education planning. All of those things fall under the purview of a certified financial planner. You'll see another designation after my name there, BFA. It stands for Behavioral Financial Advisor. A lot of what we do, and perhaps the biggest value a financial advisor could bring to your life is behavior modification. I know most of the people here are pathologists, but a lot of a doctor's role, a nurse's role, people in the medical community is hopefully to sort of alter people's behavior to have better outcomes. That is what we do on this as well here with financial planning. What I'm going to do, I've got about 30 or so slides here. I'm going to move fairly rapidly through them. It is a very generic presentation, so I'm going to talk basics with some folks. For some of you, this may be the first time you've heard of it. Some of this, it may be stuff you've heard before. But what I hope to do is at least initiate some conversations, some questions afterwards. And I already told our gracious host here that I will stay after if we have questions that run after the top of the hour. I'm happy to stay and continue to answer those questions if it works for other people's schedules. So with that, we'll get started here. This is a quick just agenda of what I'm going to talk about. I'm going to start and kind of talk the building blocks of understanding investing, because this really is the most important thing you can do for yourself to someday, when you stop working, have money to do the things you want to do. We'll talk about employee benefits. This will kind of be a segue into taxes as well. This is the biggest topic with high income earners that we run into is taxes here in the United States. So we'll cover that. We'll cover the importance of insurance, risk management. And then finally, I'll just kind of skim over it, but just again, kind of how I led here, there could be some value in working with a professional to help you with these things at some point in your life. And so we'll start with investing. The first things first, before you start putting money away in investment accounts, whether it's a retirement account, whether it's a non-retirement investment account for maybe shorter term things, we always encourage people, have your house in order. So, and we have people kind of do a little personal inventory, if you will, with some of these questions here. Before you put money in any account, you should ask yourself, do I need this? Do I actually need this money in the short term? We kind of view the short term anywhere from this year to the next 6 to 8 years. It really kind of depends on what you would need that money for. If you need money to pay the bills, that's a very short-term need, and you definitely do not want to invest that money. If it's something 6 to 8 years, some people are maybe thinking, I want to buy a dream house in the next 6 to 8 years. So it's kind of a medium-term goal. then the discussion becomes, well, we could invest that, but where are we going to put that money? There's different sorts of accounts you can use for different sorts of financial goals. Number two, am I carrying any credit card debt? I'm sure some of you know this, but consumer credit card debt here in the United States is at an all-time high, and it's continuing to grow. People who are having a hard time paying the bills are putting things on credit cards and continuing to increase their debt. There is no rate of return for any investment in the world that can outpace credit card debt. Usually credit card debt is a very high interest rate debt, so it is going to accumulate faster and compound faster than your investments ever will. So this is really important that if you're carrying high levels of credit card debt, that you have a plan in your budget to tackle that. Emergency reserve, step 3 there. It's always good to have some cash on hand that you do not touch that is there for emergencies, whether it's the hot water heater going out, whether it's any other, the car that you suddenly need some problems with the car, you get in a wreck, you need to buy a new car, those sorts of things. So we always encourage people before they invest to have emergency cash in place. And then step 4 is kind of a psychological inventory. How comfortable am I with market volatility? Because make no mistake, in the short term, you're going to read a lot of stuff. You're going to hear things in the news about how the markets are doing, and it's going to cause anxiety. And so we like to talk to people about that from just sort of a psychological perspective. But the bottom line is you want to be in a comfortable and stable place before you start to put money away. This is a quick educational slide on just the difference between the two types of asset classes that I would say 99% of investors out there need to be concerned with. And you have stocks on one side and you have bonds on the other side. Now I could sit here and read this slide to you, but I just like to kind of bottom line things. When you own a stock or you invest in a stock, you are essentially owning a company. I'll use companies that people know here like Meta, NVIDIA, Tesla, these Facebook, Netflix. These are companies that most people know about. And so when you invest in a stock of one of those companies, you are essentially co-owner of that company. You're a very small owner, but you are an owner nonetheless. And the advantage of owning stocks is as these companies become more profitable, they grow, you participate in that growth. And that is how stocks essentially go up in value. And it's how you as an investor gain over time by owning these different companies. These companies also have other ways that you can earn by being an owner of that company, typically in the forms of what we call dividends. So when a company is profitable, they will reward their stockholders with essentially extra rate of return known as a dividend that is then deposited to all the shareholders. So stocks over time grow much more aggressively than the other asset class, which you see on the right, which is a bond. So if you own a stock, you're an owner of a company. Conversely, when you own a bond, you're essentially a lender to either a company or, in some cases, governments. Could be federal government in the form of treasuries, could be to local government in the form of maybe a municipal bond. Here in Kansas City, Osama and I know that we're just talking about building a new Kansas City Chiefs stadium for the football team. That is going to come with a bond that local residents here will have the option to invest in at some point. But when you own a bond, you're now lending money to another entity, and you get a series of set payments back to you over time, interest payments essentially. Just like when you take out a loan, you're paying interest to the person who lends to you. You're now the lender in this case. These are typically a much more stable investment than stocks, but they also don't grow as aggressively. So they're more stable. That's the advantage of that, but you kind of stifle your long-term growth. In general, we believe, unless you have a good reason to own bonds, that it's better to own stocks in the long term. And this chart is simply a visual representation of why. This is a chart of if you went back to 1979 and you put $100,000 of your money in any of these asset classes here, what the growth would be today. And you can see large cap stocks, large cap is essentially the biggest companies in the United States, would have grown to almost $20 million if you just let it sit in large cap stocks. Compare that to some of the other asset classes you see on here. Precious metals, gold would have only grown to 1.1 million. Real estate would have only grown to 853,000. In government bonds, we just talked about that asset class in the previous slide, would have only grown to 1.6 million. Notice there too, we have a little bubble for inflation, which is the hot topic here in the United States right now. Inflation has been at a much higher rate for this several years, really since COVID was around. And you can see that's what you have to outpace. This is the whole reason we invest, is you have to grow your money that you have at a faster rate than inflation to essentially ensure that you have financial security at some point on down the line. This is a real eye chart here. The intent is to sort of educate on a concept, which is if you look at the left side of the top of the chart, it goes back 10 years to 2016, and then every column moving forward is another year. And all the different colors represent a different type of stock or bond class that you can own as an investor. And you can also see in there maybe precious metals, which is the black box. And the point of this slide is to show that you need to own a diversified mix of these different things. They all behave in the short term in a very unpredictable manner. And you can't, not even the smartest people in the world who do this for a living can predict which asset class is going to grow better than the other one in any given year. And so it really pays as an investor to have exposure to many of these different areas of the markets because you don't know which one's going to do in the short term. Now, we know long term that all these different things do grow over time. That is historically, you can see that on charts. And really, since we've started recording the stock market performance here in the United States, these things grow over time. But which one is going to grow at any given time, we're never really sure of. So you want to capture all the different potentials of growth by being owners in many of these different asset classes. So how do we determine that? Asset allocation is simply kind of the layman's terms of how much of stocks should I own and what kinds of stocks should I own and how much bonds should I own. So we call that asset allocation. The different asset classes that you own as an investor is your allocation. You can see here, historical studies show that more than over almost 92% of portfolio returns come from having a good asset allocation that's got a diversified mix of different things in it. You're not just investing in one stock or one single thing. And now, in the last couple decades here, we have these ways to get exposure to all of these different asset classes in what's called index funds. So there's different types of index funds, but the point of them is to give you as an investor a diversified exposure to all these different things without you having to really think about it. And so it's been a great sort of advent in the investment world over the past several decades that we now have this available. It used to be you had to go out and buy all these individual stocks yourself. Now we have these funds in place. As I said earlier in that previous slide that showed the different asset classes, the 20 million that would have grown in stocks. Again, I'll just reemphasize, for most people, it makes sense to have stocks in your portfolio so that they can grow as opposed to bonds until you have a reason to do so. Usually, typically, we are incorporating bonds or recommending bonds to people as they get close to a spending goal. And the biggest spending goal that most people can identify with is retirement. You have to start spending what you've saved all of those years as you approach retirement. So that is for most of our clients here when we typically start to incorporate some sort of bonds in there. But the reason we want to hold off on bonds is, again, you stifle the growth of your portfolio when you add bonds to it. So stocks are what are going to encourage the long-term growth. And even when you get into your spending goal, you get into retirement, you get into other aspects of life where you're spending money, you still want to have exposure to those stocks as well. So we talked about it's important to diversify, and in particular, one of the big mistakes people make, and this is what we like to focus on. We like to focus on behavior and mistakes here to help our clients avoid it, is to not put all your eggs in one basket, so to speak. To properly diversify within stocks, an investor typically needs to have at least a minimum of 25 to 30 different stocks so that if one of these companies has a really bad year, in some cases, some companies even go out of business, that's not going to sink the entire ship of your investment portfolio. Again, going back to the previous slide, the easiest way to get that exposure is to, rather than invest in individual stocks, we invest in index funds. A great example, most people have heard of the S&P 500. That is the top 500 companies in the United States, and we call that large cap. kind of short for large capitalization. And those are the biggest 500 companies in the United States. That is one of the indexes that you can invest in as a stockholder, as an investor in the United States. And so that is very common for one of our clients here to be invested in the S&P 500. And you still get exposure to all the things that you might be in love with. People love Apple. People love Tesla. They love NVIDIA. They read these stories in the news about these different companies that they want to be owners of. Well, if you invest in an index fund, guess what? You own those companies just within the larger index. So it's a great way to get a built-in diversified portfolio for yourself there. And then there's other funds also that on the private level, which we won't get into too much detail today, that you can invest in that has lots of investors, lots of companies as well. So let's talk about compounding. We have a lot of people here, and this goes into the behavioral side of what we do. They get very nervous when they read in the news or they see on TV, hey, the stock market took a dive today. The president said this and the stocks went up. The president said this and the stocks go down. And they get very antsy and they decide they want to jump in or jump out of the market and try to time the market. All the research, all the data out there about trying to time in the market shows that people that do that consistently fall way behind the average investor, that if they just put their money aside in an investment and just left it alone, would do much better. The saying we use here at Creative Planning is that it's not about timing the market, it's about time in the market. And this slide is a great example of that. So on the left here, we got Joe. He's 20 years old, and he puts $3,000 a year in an investment until age 30. So that's only 10 years, and he's getting a 7% rate of return. So he only invests for 10 years and then doesn't add another dollar to it. At age 65, that portfolio is going to be worth just shy of $500,000. On the right, we got Steven. He starts 20 years later in life. He puts double the amount of money in, and he does it for 25 years until age 65. He's invested a total of $150,000 total in his life. And at age 65, his portfolio is actually worth less than Joe on the left, who put way less money in the market. He just started earlier, and he let it work for him. That is the power of compound interest. It is not about timing the market. It is about the time you are involved in the market that really makes the difference in the long run. And if you guys remember when I talked about credit card debt on one of the earlier slides, guess what? This applies on the other side as well. If you have high levels of credit card debt and you let it sit there and you take longer to pay it off, you are going to give way more money to those credit card companies than you would if you pay it off earlier. And it's actually, this quote is attributed to Albert Einstein, which says, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. That is the difference between compound interest when it comes to stocks and compound interest when it comes to you owing money to a credit card company. All right, so in general, when it comes to investments, we want to just make sure you're ready. You got your house in order. And numbers 2 and 3 on this list are one of the most important things that you can take home from this entire presentation today, which is ignore all of the noise that you hear in the short term. If you're a 24-hour news media person, if you are affected by your Twitter feed or your X feed or your Facebook feed about what's going on in the markets, it's going to cause you anxiety. And most of it, 99% of it, is noise. It's all meant to get ratings. It's all meant to invoke some sort of emotion in you, and it's all meant to make money for these different media companies. Because when the news is just boring and people go, if the news were to say, hey, the market went down today, but don't worry, everyone, it's going to be fine in the long run, they wouldn't sell any papers and they wouldn't have people watching. So they're trying to invoke emotion out of you. So those steps 2 and 3 there are to ignore all of that, and that will keep you from making emotional decisions. And then more often than not, keeping it simple, trying not to get fancy. We get people here all the time that go, hey, I work with someone and they're doing this super sophisticated fancy thing on the side. That's a form of noise as well. We typically tell people to enjoy or to ignore. Okay, next we're going to talk about employee benefits, and this discussion might apply to a lot of you here. And this is where we get into one of the main sources of people's net worth here in the United States is their retirement plans. Now, here on the screen here, you're going to see we're talking about a 401k. This is usually people have at least heard this term. Many of you out there probably have these accounts. If you're in private practice, you may even have, as the owner of your business, you may provide this account to your different employees. A lot of people who work in hospital systems have a different type of account that's known as a 403B or a 457. For the purposes of today's discussion, just assume when I say 401k, we're talking about all of those different accounts because they behave very similarly. There's some minor differences that we could talk about individually, but in general, all of those different accounts, 403Bs, 457s, 401ks, they all behave relatively the same. Most 401ks have two different ways that you can contribute to them. You can contribute to what's called a traditional 401k. And what that means, and I'm going to give an example here in a second, is you put money in now. It reduces your tax bill every month that you put that money in. So essentially the IRS here in the United States, when you make a contribution to your traditional 401k, says, hey, I'm not going to tax that money today. That's going to go in, it's going to reduce your tax bill today, but we are going to tax it later on in life when you decide to take that out. That's how a traditional 401k works. A Roth 401k, which has come about in the last couple decades, is a different form of contribution you can make. You put that money in, the IRS does tax it on you today, but now on down the line, as opposed to the traditional 401k, when you spend that money someday, you don't get taxed on it. That's the nuts and bolts. You can see all the different contribution limits here too. I'm not going to spend a lot of time talking about that, but every year contributions limits are tied to the inflation rates. And so those numbers every year go up a little bit more. So the IRS allows you to contribute a little bit more every year into these different retirement accounts. There's a lot of reasons people don't do this though. They don't have a budget, or maybe mentally they think, I'm pretty young. I've got plenty of time to do this. Well, I would call your attention back to that previous side of the different slide where we talked about the difference between Joe and Steve, where Joe put a little bit of money away for 10 years and never touched it again and ended up better than Steve, who waited until later in life to start putting money away. The earlier you start, the less you're going to have to invest to achieve the same goal. Compounding bills to pay. We continue to hammer credit card debt for all of our clients here to try and pay that off. Same that goes with student loan debt. A lot of people that are doctors have very high levels of student loan debt. Some of them have favorable terms where they don't have any interest now, or maybe the interest is deferred. But again, similar to credit card debt, these are often very high interest debts that people have. Saving for a home. A lot of people will put off retirement saving because they want to buy that first house. It's getting tougher and tougher, as we all know, as home values go up for people to get their starter houses. So that is a goal that is worth talking about and planning for, especially in light of how can I do this and still put money away for retirement. And then a lot of people, as they start families, they have kids. That can be a little intimidating as well. Hey, there's going to be maybe some hospital cost involved with that, some medical bills, the cost of just raising a child. These are all things that sort of help people kick the can down the road and stop putting money towards retirement. We'll tell people, hey, as long as you're putting something away, that's better than nothing. Going back to the compound interest discussion, just one more graph here to visually drive that point home. This is a chart that would show how much money you would have to put away at different ages. So we have 25 years old, 35, 45, and 55. How much you would have to put away every single year to have $1 million at age 65. You can see the 25-year-old, maybe this is that example in the previous slide where we're the young family that's getting started. We want to put money away, but maybe we're trying to buy a new house. We're trying to save for the new baby that's coming. Well, realize that person only really has to put a couple $100 away to still have that $1 million at age 65. Fast forward to, you can see the difference between 35, 45, and 55 years old. Well, if you wait till you're 55, you're putting in a significant amount of money every month to make that $1 million account balance happen at age 65. So again, just to kind of put it in perspective for people who think they can't afford to invest, if you have everything in order at home and you have a couple $100 to spare and you're one of these young people on this call here, it doesn't take that much to make these goals happen if you start earlier. This is one of the biggest benefits in the United States for retirement accounts. So going back to our 401k discussion, most 401k plans have what's called a match. I'd say probably an average match that you would see out there in corporate America is somewhere around 5 to 6%. And what this means is on the first several $1,000s that you put in a 401k. Your company will typically match you on that. So if you put in 10,000 in a year, your company may match you that 10,000%, or sorry, $10,000. And they'll do it up to the amount of money you make. So if you make $100,000 a year, I'm just using easy math here for presentation's sake, and they're doing a 5% match, that means on the first $5,000 that you put in a 401k, they will match up to that 5,000. If you make $200,000 a year, then that doubles. It would be $10,000 in a match. And this is the best return on investment you can possibly make in the entire United States. It's an automatic 100% rate of return. If you put $5,000 in, there is no investment in the world you can do where you'll automatically make $5,000 rate of return on the investment. So we tell everybody, no matter how young you are, if you can afford and budget to at least put in enough money in your 401k to get the match that your company offers, then you should do it. It is a free 100% rate of return. And every year you wait to do this, you are missing out on that free money. So this is something we really emphasize with all of our clients here that have access to an employer plan like that. 529 plans. There's a lot of folks here that might be looking to put their kids through college. This is the most popular and efficient way to do that, to put money aside for education. Education, a lot of people think it's college. It could be all forms of college. It could be for an undergraduate degree. It could be for graduate or even PhD level. It could be for medical school. It could even be for private school. Once upon a time, I was a pilot. My dad actually used one of these accounts to pay for flight school for me. So when I was a much younger person. So this can be used for all forms of education. But the advantage of this is you put money in, depending on what state you live in the United States, you could get a state level tax deduction. Similar to how we talked about the 401k, when you put money in there, you can reduce your tax bill. And don't worry, we're going to talk about taxes here in a second. But you put that in there, and then it grows tax-free. And then if you use that money on education in the future, if you spend that money on education, you don't ever pay taxes on that money. So it's a great way to save for your children's education and reducing your tax bill. And you can invest a 529 similar to any other investment account. You can put stocks in there, you can put bonds in there, and you can really grow this money. And it can be a more efficient way to do this than just budgeting and cash flowing for education for your kids. If you wait to do this once they're college age or once their education goal is basically needs to be paid for. All right, everyone's favorite topic, taxes. This is an eye chart right here, and the intent is not to show you or have you memorize anything here. This is what every good financial planner or a wealth manager has sitting next to their desk at all times, is they have every current year's tax brackets and all the tax information. We do have one of the more complicated tax systems here in the United States, and so it really pays to have somebody looking at these things for you, especially as you make more and more money and pay more and more money back to Uncle Sam here in the United States. Again, going back to the basics, one of the best ways as you become a higher and higher income earner, if you're not already there as a doctor, is to put money in your 401k and use it for the pre-tax amount. So we talked about this a few slides ago about 401ks, and this is just to give you an example. So here we're using an example here of someone who makes $70,000 a year, just for, again, for very easy math. And you can see on the left, the contribution goes in tax deferred. Tax deferred means it's not tax-free. It means you're not paying the tax on it today. You are going to pay it later when you withdraw it. And on the right, you can see the example here of making $70,000 a year. We have, in this example, this person's paycheck before taxes and before contributions to their 401k is just shy of $3,000. They make a 401k contribution of $146. And you can see now the taxable income is less than the gross pay. They reduced their tax bill today by making a 401k contribution. So it's kind of a double whammy. It's great. You're putting money in an investment account that's going to grow and compound, and you're reducing your tax bill today. Compare that in this next slide to that Roth contribution, that after-tax contribution. So now in the same example, just like we talked about with the 401k slide, you're still putting the same $146 in, but you're not getting a tax break on it today. You can see those the two lines. The gross paycheck is $2,917 on the right, and the taxable income is the same, 2,917. So you're not getting a tax break today. The advantage here, though, is you'll never pay taxes on that contribution or the earnings that come from that ever again. A general rule of thumb, this is not financial advice necessarily, but a general rule of thumb is if you're earlier in your career, so someone who's starting out as a doctor, you're in your residency right now, your income is much lower, it usually is more beneficial to put money in the Roth part or the after-tax part of your investment accounts. And then as you make more money and your tax bracket goes up here in the US, it usually makes sense to try and reduce your tax bill today by making those pre-tax contributions, these right here. So older, making more money, higher tax bracket, we tend to recommend people put money in pre-tax. Younger, making less money, we tend to recommend people put money in the Roth. And that way you'll have a mix of both different kinds of money as you approach retirement. You'll have a balance that's got traditional in it. You'll have a balance that has Roth in it. Tax loss harvesting. This is just a brief slide I want to cover here. It's another way that we help people here reduce their tax bills. This can be a very powerful thing if you're someone that goes into private practice. You own your own medical practice. You're going to maybe sell that practice someday. Tax loss harvesting is a great way that you can create tax losses and then use that at some point in the future to maybe offset a tax bill in your future. A lot of people who sell their private practices, they grow, they do really well, they sell it for a lot of money, and then they get surprised when they have to pay a lot of taxes on all the growth that they put into their business over those years. Tax loss harvesting can only be done in a non-retirement account. So there's another kind of investment account called a brokerage account. And what we do in this is we sell a position when there's market volatility intentionally for a loss, and we replace it with a different investment that behaves the same way. This chart right here, where the arrows are, that's basically showing what happened in COVID. We had stocks were going up, and then everyone, went into a panic during COVID. You saw stocks temporarily drop that year in 2020, and then guess what? They continued to grow and reached new highs. Well, what we're doing in this example here is when that big drop happened, and we did this for our clients here, we intentionally sold a lot of the positions in their brokerage accounts that we managed. They got a nice big tax loss they got to carry forward and continue to carry forward on their tax return. And then someday on down the line, they're going to have some event in their life where they have a tax bill they need to deal with, and we're going to apply those losses to it, and we're going to offset that tax bill. This is kind of a complicated concept. I'm just introducing it here, and it may invoke some more questions here. That's all I'll say about it right now, but if people do have more questions about that, I'm happy to talk about that. Okay, next, insurance. We're going to talk about different lines of insurance here briefly. There's different kinds of insurance here, and some of them you'll pay all of your life, no matter what, like property and casualty insurance. If you're a homeowner or you own an automobile or any kind of property, you are always going to have that insured, as opposed to insurance like life insurance or maybe even disability. These are lines of insurance that we can eventually, if we do good financial planning for you, we can actually do what's called self-insure. When you're younger, you have a high income, but if you were the risk of you essentially dying and losing that income for your family, if that would be catastrophic to your family, then you need life insurance. As opposed to someone who is later in life, has done a great job saving, has lots of money saved up in investment accounts. And so if their income disappeared tomorrow, if they were unfortunately were to die unexpectedly, well, then their family would still be covered because they have lots of money set aside already in investments. And so their family would be okay. And so those are the difference between, insurance lines of insurance that you always have to have, and lines of insurance that you can do, again, what we call self-insuring against. But insurance is just a fancy term for transfer of risk. When you buy insurance, you are transferring the risk of something bad happening in your life, and you're putting it on an insurance company. Some other lines of insurance on here, long-term care insurance, that's typically something that you can self-insure as well. So we have a lot of clients here that have done a great job saving, and we do not need to have long-term care insurance for them, because if something bad happens, if they end up in some sort of home, medical home, need in-care, nursing care, something like that, they have enough assets saved up aside that they can just spend that money on that rather than buying a very expensive policy. Same on the disability side. And then one thing that's very complicated, you all have probably seen it as doctors, is the whole Medicare health insurance world. That is a whole different monster that we have our clients navigate. And one of the cool things we have here at Creative Planning is we actually have a Medicare team that really understands that line of insurance for anyone here in the room that eventually is either on Medicare now or maybe have patients that are navigating that world as well. Oh, one other thing I just want to say about this, there's different types of life insurance. You might have heard of term insurance is one form of life insurance. Whole life is another form. Almost in all cases, we recommend to cover your family on the life insurance side, we recommend people buy term insurance. It's much more affordable. And again, the goal of life insurance is to get yourself to a point where you don't need it anymore later on in life. And so the best and most efficient way to do that is to buy term insurance. It's much more affordable, it's much cheaper versus whole life insurance, which is meant to last your entire life, but it's very, very expensive. And most people don't do it or don't need it. If you've done a good job saving and investing, you'll get to a point in life where you don't need that insurance anymore. So just wanted to share briefly on that as well. All right, this is getting towards the end of the presentation here, and then we'll open up to questions. Working with a wealth manager. These are the different things that we do here. So we're goals based. And if you work with us, if you were to work with anyone else or decide you need to work with someone in the financial planning industry, you want to find somebody that's focused on goals first. Osama and I were just talking before everyone joined, and he was talking about this lecture series that he runs in the professional development. Everyone here is a doctor for a reason. You had some sort of passion for it. You had some sort of interest in the medical community, but you don't do it out of the charity of your heart. You do it because you have goals that you want to do. You want to buy a house. You want to retire someday. You want to go on vacations. You want to do the things with your family that create memories. All these things take money. And so we are very hyper-focused on goals first. If you were to ever do a planning meeting with us, the very first meeting we do has nothing to do with advice. It has nothing to do with telling people what to do. It is a meeting that is solely focused on figuring out what it is people want to do with money the rest of their lives. All those different goals that you see on the screen here. And so you want to work with somebody that is goals based because that should drive every decision and every recommendation that they make for you. One of the unique aspects of what we do here is also it's very comprehensive in nature of what we do. We have a lot of different strategies that we use here, and you can see some different things on the screen here. You know, we've talked about stocks and bonds. For some clients and some people out there, it is appropriate to get into some other more sophisticated forms of investments. I've just listed some of them here on the screen here. The intent is not to go down the rabbit hole and discuss all of these, but just realize there's a lot more instruments out there that you can use in the investment world. And one of the unique aspects of our firm is we have access to all of these different things. What our process is here, these are just some stats here. This is what's unique about our financial planning. And please don't take this as some sort of pitch or sales thing, but it's just to tell you who we are. A lot of financial planning firms out there are in the business of selling products. What does that mean? Their intent and the way they make their money is they want to sell you a certain investment. They want to sell you an insurance policy. That's how they make their money. Creative Planning is what's called an independent advisory firm. What that means is we don't sell products. Now, we make recommendations on investments. We make recommendations on lines of insurance. We do all that for our clients, but we don't make money on those different things that we recommend. So we're independent. And what that means from a client perspective is we're a fiduciary 100% of the time. We are always choosing things that are in the client's best interest first because we don't make money on those different things that we recommend. So there's no conflict of interest there. The other aspect is everything's tailor-made here. We customize our investments. I can talk more about what that means here individually if you'd like. But we customize every single financial plan, every single portfolio is tailor-made to every client here. There's no two that are the same because the way we view financial planning is everyone's situation is going to be a little bit different. You all are in different spots of your life. You have different ambitions, different aspirations. So your plans should all be different as well. And just some of the stats at the bottom there that show why we got that Wall Street Journal ranking that I led this presentation with is some of those numbers at the bottom. We manage over 700 billion now in assets. We're across all 50 states, and we even work now in multiple different countries as we continue to expand and grow as a company. This is a brief chart of just all the different aspects that we cover. You can see there's a lot of things here. You might not even know what some of these mean. For the folks out there, and just a brief plug for this, that may be in private practice, that maybe have an ambition of starting their own practice someday, you're essentially, as a doctor, signing up to become a business owner as well. And the goal of us being able to help business owners here is we want you, as a doctor, since that's our audience here, we want you to focus on being the best doctor you can possibly be. And so not only do we take over the planning for all the things in your individual life that we've already talked about, insurance, investments, things like that, but we have a whole in-house suite of services as well that help the business owner as well. So if you're someone that has an aspiration, or you're a current business owner and you feel overwhelmed, in over your head, we have everything from helping you create that retirement plan for you and your employees and your doctors, helping you sell your business someday, doing the accounting, doing the payroll, doing all of the different things that take up the time of a business owner. We take that off your hands to free you up to be the best doctor you can be. Or if you are some other business owner, just using doctors obviously as the example for this room, but we can do that for any sort of business owner. But the purpose of this slide is to show you that our wealth management firm is much different than other firms, because we don't just help with investments. We don't just talk about retirement planning. We help with planning in all aspects of people's lives: estate planning, tax planning, business planning, you name it, we do it here. And then finally, just kind of a brief discussion about who a wealth manager is, someone like me here. Wealth manager is kind of like the quarterback of the team, to use a sports analogy. I like to use flying analogies. It's sort of like the captain of the airplane. Wealth manager has all these different specialties on their team at their disposal. Osama could probably tell you about his experience with our firm here, where he has a main point of contact, and then that wealth manager has all these different specialists, subject matter experts that sort of do all these different things for that wealth manager. And then finally, just the slide here. Everyone, anybody here in this room, if you're ever interested in working with us, we basically do a planning process that's no obligation. It doesn't cost anything. And we run you through that goal planning meeting that I talked about, where we learn about your goals. We create a financial plan. We run through a second meeting where we give you a list of recommendations about how we think you should proceed. That's all complimentary. If you're ever interested in learning more about our process, that's something that my team can do for you here as well, if you are interested. So that's it. That's the end of my presentation here, at least the pre-planned part. That's my contact info. Osama has this as well. This is going to be recorded. So if you ever have more questions individually that you don't want to ask today here when we open it up to Q&A, that's how you can get a hold of me. And with that, I'm going to stop sharing the screen, and we can go to questions and answers.
Thank you so much, Jesse.
Absolutely.
It's a world of information. People can see how complicated it is. And but the issue is really important for everybody to make sure that they know what they are doing, how they are doing it. You might be good at certain things, but not the others. The value of having somebody explaining how important the entire enchilada is,
yes,
is critical for the success of people's life. Folks, if you have any questions, we have a few minutes to ask. Feel free asking questions. I have one with raising hands. Mai, go ahead.
Thank you, Jesse, for this amazing, very informative session. Like, I really appreciate it. So maybe it's like a naive question for you, or but this is like a cultural thing, I guess. And also, like, I heard a lot about gold bars, right? Like here in the United States, and even like back in Egypt, like this is like very cultural thing to use gold like as an investment. What do you think of this?
Yes, that is a great question, and it's one we get a lot, is what about gold? What about precious metals? Gold, and I'll keep it very quickly here. Gold, we typically don't recommend gold as an investment. And there's a couple reasons behind that. If you'll remember when I talked about stocks and how they grow, and you saw the bubble, you saw the gold, the bubble of the stocks, the portfolio would have grown to $20 million if you invested $100,000 in that in 1979. But then the gold one didn't grow very much. And the reason being is gold is not a company. It has no internal value that causes growth. A gold bar will always just be a gold bar. And the only reason the price changes is it's based on sentiment. The price of gold is worth on any given day what a human being thinks just feels like it's worth. Whereas a company, whether you're a doctor, whether you own Tesla, whether you're McDonald's, or name your any business out there, you're bringing value in a service or a product to people. And so that's why stocks grow. And they have an internal sort of intrinsic worth that continues to grow as those companies grow. The other things that gold bars don't do is they don't compound. So in other words, if you have a gold bar and you sit it there, it's not going to create other little gold bars that you can continue to go up in value. Whereas when you own a stock, I talked about dividends earlier, as that company grows, they're going to continue to give you money from their earnings and their growth that you can then use to buy more of that stock. So even if you don't do anything, if you don't buy any other stock, the dividends there will continue to compound the growth of that investment that you have. And so it will internally start to grow. That's one reason we don't recommend precious metals, is they don't really have any intrinsic worth or product or anything that they do. They don't compound either. The other aspect is they get taxed at a very different rate than stocks and bonds do. So when you own a gold bar and then you go to use it somehow, there is a much higher tax rate applied to that as well. So that's number two. And then the last thing, one of the objections we get about people being nervous about markets, they think, hey, I'm told, I see on the news I should buy gold because the dollar and inflation, and I should buy gold. And they're worried about the dollar going to zero. They're worried about currency in their own country going to zero. My response to that is if the entire currency system collapses someday and money is meaningless, I don't know what you're going to do with a gold bar. I don't know if you're going to take that to a gas station and give the guy across the table a piece of gold to try and buy a tank of gas. That's not really how things are going to work. You still will have to eventually exchange that gold bar for some form of currency to get any actual use out of it. So those are just three reasons why here we don't really recommend as a going and game plan for people to invest in gold. Now, certainly we have clients that do have precious metals and we advise them on that, but it's not something that we necessarily recommend to people. Did that answer your question?
Absolutely. Thank you so much. This is really, really helpful. Thank you.
Absolutely. Yeah, my pleasure. Thank you. And thank you for the compliment as well.
Dr. Mustafa, go ahead.
Yes. So first, thank you so much, Jesse, for a wonderful presentation. I really like how you simplified a very complicated topic that even I can understand. So thank you so much for that. So Jesse, my question is, so aggressively paying the mortgage early versus investing in stocks. Which one do you think is more financially better plan? With paying the mortgage early, you kind of guarantee saving, which is, I'm not sure what the current interest rate is, 6 point something, but it's a guaranteed saving versus a higher return from the stocks, but it's not a guaranteed return, right? So which one do you think is best on the long run?
Yeah, this is a great question. And this is one that we run our clients through from a financial planning perspective of trying to figure out which one of these to do. First of all, you're right. The interest rates are higher today, right? It used to be several years ago, you could get a mortgage for 3%, and now it's in the 6% range. Even still, the stock market's rate of return on average over a 20-year rolling period is somewhere in the realm of 10, maybe even higher percent. So even with higher interest rates on mortgages, you can usually take that money you would have used to pay off a mortgage early, invest it, and increase your bottom line over paying off the mortgage early. Now, I have no problems personally necessarily with people wanting to add and sort of accelerate the paying off of a mortgage. The other thing to realize is inflation is always eroding the dollar. Inflation is, the average that we kind of target is 2 to 3% a year. So if you have $1 that just sits there in a bank account, every year that dollar is going to get more and more worthless from a purchasing perspective. Now, this actually has a positive effect when it comes to mortgages, though. If you have a $500,000 mortgage at a 6% rate, well, over time, over a 30-year period, let's say it's a 30-year mortgage and you just bought it today. Well, over 30 years, that $500,000 debt as you pay it down is actually going to become less and less of an ordeal, right? Because home value is going to keep going up. $500,000 of debt today is going to be a much smaller number of debt, due to inflation, some 20, 30 years on down the line, when houses will cost, who knows, the same house would cost you $2 million or $5 million or something like that. So typically, again, this isn't necessarily financial advice, but as a rule of thumb, we were going to look at the rates of return you can get in the market versus paying off a mortgage early. And then we're going to have that discussion about, well, the fact that debt over time actually becomes cheaper and cheaper for you, because guess what? Your pay is going to go up over time. The amount of money you make. So a $5,000 mortgage payment or a $3,000 mortgage payment may seem expensive today, but if it stays the same over the next 20, 30 years, that's going to become a much smaller item on your budget, your monthly budget every year, as your income goes up, as the dollar basically inflates over time. Did that explanation make sense?
Yes. Thank you so much for that. Yeah,
okay. Yes, absolutely.
Anybody has any other questions? While you guys are thinking, I have a question.
And if you have questions you don't want the room to hear, like I said, you have my contact info as well. So happy to take those questions offline as well.
Jesse,
Seba, there are some questions in the chat.
Oh, okay.
Oh, I didn't see it.
I don't have access to the chat on my screen.
Okay, thank you very much. How would your company, how would you compare bank stocks with index stocks?
Bank stocks? Okay, great question. A bank stock is just another company, right? A bank is a company. Tesla is a company. Meta is a company. If you own a bank stock, you're just owning stock in any other company like anything else. We rarely, if ever, recommend people buy individual stocks. Even an individual stock, if a bank is, if you're looking at the history and track record of a stock and it looks like it's doing great and it's a bank, we would still offer that you need to diversify over just one individual stock. If it's a big bank, you're going to get exposure to that bank by buying an index fund. If you buy, I don't know, there's some big bank names out there, Bank of America, Chase Bank, some of these big names in the United States. If you invest in the S&P 500 index fund, you are going to get bank stock as part of that, but you're going to get it mixed up with 499 other stocks as well. And then add mid-cap stocks, small cap stocks, all the things that we would do in a diversified portfolio. You're going to have an entire global exposure to every single company in the entire world, which is good. You're going to participate in that. But if one of those companies doesn't do well, again, you're not going to sink the ship with just one company failing. So we're pretty agnostic about individual stocks ever. People could come to us, they could ask our CEO, Peter Mallouk, what do you think of Tesla stock? And he'd say, hey, it's doing great. Or what do you think of NVIDIA stock? Hey, it's phenomenal. It's doing great, but we don't know what it's going to do tomorrow or in the next 5 years, 10 years. It could continue upward. It could continue downward. It could go out of business. We don't know. So that's always going to be my answer for anyone that asks me about any individual company, any individual stock. I'm going to say, hey, it looks like it's doing okay right now, or it's not doing great, but I would never recommend you just go buy that one stock. Did that make sense?
Yes, thank you.
Okay.
Okay, there is another question about what do you think of Bitcoins?
Bitcoin. So crypto, we get a lot of questions about crypto. Crypto, similar to my discussion about the question about gold. Crypto right now is still in its infancy. So that's number one. And again, it's just worth whatever public sentiment thinks it's worth. So if you own Bitcoin, and you've watched it go up, you've watched it go down, there is nothing driving that price up or down other than what people think about it emotionally and mentally at any given time. If people start selling off out of Bitcoin, the price goes down. If people feel very bullish about it, and they start to put money into Bitcoin, it goes up. But it's not providing any real value or service yet to people yet. So that's the big caveat here. Bitcoin so far has kind of been the front runner in the cryptocurrency world. But realize there's 1,000 different cryptocurrencies out here. And the world as a whole has not settled on a standard yet. That may change in the future. So right now, our advice for people when it comes to cryptocurrency is probably not something that we would recommend you invest in necessarily yet. But if you like the technology, so, you know, it's a part of this, and I don't want to go down the rabbit hole of the technology that's behind Bitcoin and other cryptocurrencies, but this gets into a whole discussion about blockchain technology, which is very innovative. The technology itself is something worth investing in, which again, I would never tell you to invest in a single company. I would tell you to invest in the stock market in general through index funds, and you will get exposure to blockchain technology, just like you'd get exposure to banks. Once the world settles on a cryptocurrency at some point in the future, then there could be a discussion point of, okay, does it make sense to own this now? But right now, it's pure speculation. The people that are investing in Bitcoin are simply making a gamble, a gamble that, hey, I think this is going to take off someday, and I hope it does. Just as easily, it could go to zero. So do we have clients that invest in Bitcoin? Absolutely. We guide them on that. We invest, we kind of talk them through owning that. And our goal here is, as a fiduciary, to make sure they're not overly exposed to it with so much of their net worth in Bitcoin that if it does go to zero tomorrow, they're going to be in a catastrophic financial situation and their whole financial plan falls apart. We're trying to mitigate that for them. Good question. More questions.
Okay, I was muted. I see a question about is investing money in sector stocks like semiconductors, which has high earning potential, considered safe to put money in?
Yeah, so great question. A lot of people, a lot of investors like to focus on sectors. It could be tech sectors, it could be, you know, just like the sector you mentioned, it could be the airline sector, it could be the medical sector. Again, we tend to focus less on sectors. You're still going to get exposure to sectors by the way we recommend people invest, which is to invest more in capitalization. So I showed you the S&P 500 is large cap. There's smaller companies that are mid cap. There's smaller companies in that are small cap, micro cap. You could do the same thing internationally. There's international, large, mid, small. And so the way we invest still gets you exposure to that, but we don't just focus on a sector per se. The danger of putting a lot of money in one sector, I'll give you an example here. I'll give you an international geopolitical situation. One of the biggest semiconductor chip makers locations in the world is Taiwan. Well, everyone who's paying attention to international stuff right now knows that there's a lot of tension between China and Taiwan. And if China were actually to drop the hammer someday, a lot of people out there speculate it's not a matter of if, but when, were to basically go and invade Taiwan and take over all the chip making facilities that they have there, you would see in the example of that sector you mentioned, you could see something that's going from growing to suddenly catastrophically falling overnight because the whole world would freak out now that China had all that capability and basically had that. So that's a reason why we tend to stay away from focusing and waiting on sectors per se. We again try to stick more to a capitalization standpoint. So within large cap stocks, there is tech sector, there is medical sales sector, there's you know, medical, by the way, is one of the hugest industries in the entire country. All the different sectors are comprised within those different things. What we don't want to do is just focus a big part of your net worth on one particular sector of the economy, because those sectors tend to kind of stick together and rise and fall together as well. Did that answer your question in the chat?
Yes, it did. Thank you so much.
Okay, good question.
Omar, why don't you ask the next question that you have?
All right, thank you. So thank you, Jesse, for the presentation. It's a great presentation. I just the other question I have is regarding the S&P 500. I think this is maybe like the as a diversity of the stocks in it, and just like how it's like widely just covering most of the corporates, like the biggest 500 corporates, like in the US. So I think it's maybe like the safest option. But I would like to ask you about, are there any other safe options that maybe have like like higher earning potential that S&P 500, or not really? This is the best thing that you can invest on for the long term. Thank you.
Great question. So the bigger the company, the more stable it is typically. So the S&P 500 are the biggest companies in the US, and you'll find that it grows pretty steadily as an index. And it has volatility. So, stocks always have volatility when there's news in the world and all that. And the economy, bad news comes out, good news comes out. You'll see the stock market kind of act accordingly. But the companies in the S&P 500 are usually pretty tried and true, well-established companies. And the rise of the S&P 500 is pretty consistent. So when we say the stock market averages 10 to 12% a year in a 20-year term, we're usually talking about the S&P 500. As you get to different level aspects of the U.S. markets, and you could say the same internationally, so you get to mid cap, small, all the way to small cap. What we're saying here is these are companies that are smaller in nature, all the way to small, and even we have micro cap U.S. companies. These are the smallest companies now that you've probably even never heard of. Once upon a time, Tesla was a small cap company. And what you'll find, the characteristics as you get to smaller companies is they tend to be more volatile. So the roller coaster ride, if you look at a chart of them, is much steeper. But you'll also find that they tend to be more aggressive and grow more aggressively. So again, to use Tesla as an example, I like to use this because everyone's heard of Tesla. You'll find that in its early days, very, very volatile, but also grew very aggressively. And that's when people started jumping on the Tesla bandwagon because it was just, if you looked at it on a chart, it was just going up. Well, as they grew in size and became more stable and more established, they continue to grow, but it's a much more stable roller coaster right now. It doesn't mean it doesn't have volatility, but it's much different than it was however many years ago when they first came on the scene. We get exposure to all of those for our clients. And then this is getting into sophisticated portfolio management. It's sort of what one of the things people pay us to do is we will place these different segments of the market in different accounts based on how they behave. Are they more aggressive? Are they more stable? And so you're going to find the smaller the company, the more aggressive it's going to be, the more growth potential it has, but also the bigger pit in your stomach you're going to have in the short term when bad news hits, right? Right now, one of the asset classes out there that's the most aggressive in 2026 has been growing most aggressively and has probably had the highest rates of return this year is emerging markets. That's a fancy term for international stocks that are in kind of third world parts of the country and other sort of volatile countries. Think China, Russia, things like that. And it's been doing great. It's been outperforming US stocks this year. But it's very volatile, right? So just because it's doing well this year, it could go in the tank next year. So the roller coaster ride on that particular asset class, very, very unpredictable. And so that's what you find all the way to remember our discussion from bonds. Bonds, very, very predictable, but they don't grow a whole lot. And the saying we have here is the more volatile a stock is, it's kind of the higher premium you're paying for that long-term growth on it. So that would be my answer to that. There's nothing that we ever say is quote unquote safe. You know, every stock has the potential to go to zero tomorrow. The safest way to get exposure to that is, again, to have exposure to as many different things as you can. So not one asset class brings the whole house down. If you look at the S&P 500, if you go back and you just Google or you run a chart of the S&P 500 performance from the year 2000 to 2009, we call that in this industry the lost decade. If that's all you had been invested in, because we get this question a lot, why don't I just invest in the S&P 500 and nothing else? If you had just invested in the S&P 500, you would have seen for almost 10 years flat performance. In fact, if you just would have invested in that and not done anything else, you actually would have lost a little bit of money to inflation because the performance during those 10 years was just basically flatlined. But if you had exposure to all these other areas in the market, US mid cap, small cap, international, emerging markets, all these other things, you actually did pretty well. That's why we tell people, don't just put all your eggs in one basket, even just one area of the market, right? Even just putting your money in the S&P 500, we view that as putting all your eggs in one basket. Did that answer your question, Omar?
Yes, it did perfectly. And I think I will, like, if you don't mind, like, out to you, like, personally to get more,
Absolutely.
like, just advices and more, maybe, like recommendations about more planning for how to get like a good I think wallet for investment and how to select more stocks which could diversify the investment like in a smarter way and safer way as well. But yeah, thank you so much.
Really, thank you, Omar. Thank you for the question.
Yep, and thank you, Dr. Taufi, for just hosting the lecture today. Thank you.
My pleasure. I have one final question, if you guys don't mind. Jesse, AI is getting into everything.
Yes.
In our medical field, in pathology and whatnot. I'm sure it is going to be impacting your financial world. Can I go to Chat GPT and replace you?
Great question. This is probably the most popular question we got. AI, and I would ask first kind of the same question to doctors here. Is AI going to replace doctors? And I think most people in here would be adamant to say it's going to help us in our job, but it's still not going to be a replacement for a relationship and the human element that's required in medicine. Now, I kind of mess around with this. I have ChatGPT as well, and I kind of like to see where it is at this point. And I have put in some sophisticated portfolio, just on the investing side. I put some sophisticated portfolio information in there. And it doesn't do a great job of taking into account the whole situation for somebody, right? It doesn't take into account their real estate, their estate planning, and all these other things. Can't do that yet. Is it going to get to that point in the future? I don't know. It might. The other thing is AI is limited to what we already know as humans, right? The only information source artificial intelligence really has to pull from is what our known knowledge base is already as human beings, right? If the rest of our generations, and I try to get my kids to realize it's like, don't just rely on AI to like tell you everything, because we're just going to get dumber and dumber. We're not going to learn new things in the future, and we're not going to have any inputs to give AI in the first place to continue to increase the knowledge base. So my answer to that is AI does a lot of things that help us in our job, mainly on the efficiency side. AI does things like takes notes in meetings for us. It can recall a lot of things and sort of be a good note taker. I even see right now in this chat, there's an AI note taker somewhere on the Zoom thing that's taking notes for this meeting, which is fantastic. I love it for that. But similar to other advances in technology, manufacturing back in the day, where we suddenly went from building cars by hands to we have assembly lines doing it, it's really still just a helper. There's still human beings that need to be involved in the process. It'll be the same for medicine. I think it's going to be the same for financial planning as well, at least into the foreseeable future. Does that mean that AI is not going to be a huge helper and sort of make things more efficient to us? Absolutely. I think it's going to allow us to handle more clients and do a lot more workload and make things more efficient. So that's where we are right now on it. But yeah, I like that question. And the other question we get to is, should I be investing in AI? Well, guess what? If you're invested in the markets, you're invested in AI, right? So
Well, thank you so much. Thank you,
Absolutely.
thank you. As I mentioned, this lecture is going to be recorded, and Jesse's will have his contact information available for you guys for future communication. Until we meet again, I wish you guys all the best and have a great rest of the weekend.
Yes. And hey, thank you for inviting me to this. I'm honored to be a part of this. And thank you for including me in your lecture series.
Thank you. Take care, guys.
Bye-bye. Bye-bye.
Bye.